I really doubt that we're going to see an inflationary cycle.
It will have a temporary or transitory impact.
The faster than expected increase in some of those prices is actually a good sign.
The overwhelming consensus is going to pop up a little bit and then go back down. No one's talking about this great,
This is something that will settle down.
Transitory.
Most of the price increases we've seen were expected and are expected to be temporary. It's highly unlikely that's going to be long-term inflation that's going to get out of hand. I don't know anybody who's worried about inflation.
Over the last couple of months, we actually saw it trended downward.
President Biden's chief of staff, Ron Klain, enthusiastically retweeted an economist who had said in part most of the economic problems we're facing, inflation, supply chains, et cetera, are high-class problems.
The number one thing that the president can do is help get COVID under control. That we know is the root cause of inflation.
President Biden this afternoon saying he thinks we're at the peak of the crisis right now and that lower prices are on the way.
The inflation has everything to do with the supply chain. Make no mistake, inflation is largely the fault of Putin.
If you want to get rid of inflation, the only way to do it is to undo a lot of the Trump tax cuts.
Our inflation rates are lower than other nations in the world.
The inflation we're seeing is due to the pandemic.
When inflation hit a new high last week, the administration of President Biden called the numbers out of date.
I just want to say a number: 0. Today, we received news that our economy had 0% inflation.
When I hear people talk about inflation, as I heard him there, we have to change that subject. Inflation is a global phenomenon.
Welcome to the Stocks with Josh show. This is not a political comment. I am simply pointing out that back in 2021, back in 2022, inflation was being seriously discounted as a concern on the political stage. And yet here we are in 2023, March. We've gotten another 25 basis point rate hike, inflation down to 6%, and we know the Fed is pushing for 2%. It seems to still be his biggest concern. We've just gone through the beginnings of a banking crisis, and that wasn't enough to get him to stop, pause, or even talk dovish moving forward. He's given us the same narrative that he has given us in the past. He says we're going to get inflation down to 2%. We're going to give you guys another rate hike. There's more rate hikes ahead, and we're going to hold them throughout the end of the year. The man knows that the banks are crumbling. He knows they've lost billions of dollars. I've told you on this show that the banks are insolvent. America's biggest banks, Bank of America, JP Morgan, the biggest banks in the world are sitting on hundreds of billions of dollars of unrealized potential losses. And you know what? The Fed says we'll come through. We'll keep the depositors whole. We'll take care of it. We know, though, that when the Fed says they'll come through, they don't have that money on their balance sheet. We already know that they do not have that money to give directly to the banks, which means that they've got to print money. And therein lies the problem that the politicians told us wasn't a problem. It's as if nobody who is in a position of leadership in this country will come right out and tell the American people it's that when we're printing money, that's quantitative easing. When we are printing money, we are stoking the flames of inflation, and inflation is a really big problem. This is the Stocks with Josh show. Thank you for hitting the like, hit subscribe, and the all YouTube notifications bell to get daily stock and crypto videos. Remember, there are scammers in the comments section. They use my picture and my name. They try to get you to DM them on WhatsApp and Telegram. It's not me. All right, I had a handful of big takeaways from the Fed's talk yesterday that I'm going to share with you. Number one, the Fed intends to fix inflation at all cost. Number two, the banks are in crisis. The Fed knows about it. And I'm going to tell you right now, it's going to lead to a massive credit crunch that's going to be felt by all of you. They're not going to lend money. They're not going to lend it easily. It's going to be only people with the very best credit who don't even need to borrow the money. Those are the only ones that are going to get the money. And this is going to lead to a massive credit crunch. They are not going to give away and lend out deposits when they need to hold on to every single dollar, not knowing if a wave of fear is going to come in and cause people to pull money out of their branch. Every last one of them knows something that you don't. They're looking at their balance sheet, and they know full well they don't have your money. So if anyone else gets outside knowledge of the exact situation that they're in, they know they could be subject to a pull. They could be subject to a rush on the bank, and they're not going to be lending out money. That's going to have a direct impact on every single American. It's not going to hit those who don't need the money. It's going to hit you when you need the money. Number 3, the Fed made it very, very clear that he's got a goal of reaching 4.5% unemployment by the end of this year. And I'll tell you, if we can believe him, and I'm going to cover that in a little bit, whether or not he's bluffing or whether or not he's telling the truth. But what his position is very clear. He's not going to pivot. He's not going to cut rates until he gets his target goal of 4.5% unemployment. Right now, I believe we're sitting at 3.6% unemployment. So it'd be a significant upswing of lost jobs between now and the end of this year. That's what it would take to move the Fed. He's, you know what, he said it. Banking crisis, we'll solve it. We'll print more money. We need to see that unemployment number tick up. That's what we're looking for. So that's also going to mean that for us moving forward, anytime that we get a strong jobs number, we're going to know that the market's not going to respond to that well. We're going to see a sell-off. That is definitely going to be a signal that we need to watch each and every time we get that jobs report. And then finally, recession. The question of whether or not we're going to have a recession. When the Fed was asked about the potential of a soft landing, he said, and I quote, "These bank issues makes it seemingly less likely." So the Fed has come right out. That's one of the things that the market didn't like. That's one of the reasons why the market sold off. He said, I'm raising rates. I'm going to push for unemployment. And I don't see a soft landing ahead of us because we have the crisis of the banks, which can continue to build more crisis. All right, but here's the big point that we need to examine today. It's March 21st. We're 3 months into 2023, the big bottoming recession, horrible crash year that everybody was talking about in 2022. Even though the markets went down quite a bit in 2022, they're saying, you know what, the dark days are in 2023. And I'll be honest, I participated in that. I began to think that we would see some really dark days here in 2023, but we're not seeing them. One of the reasons being the smart money is calling the Fed a bluffer. They don't believe it. They're not pricing it in. So even though we're beneath the 50-day moving average, which is bearish, we're actually above the 200-day moving average and currently using it as support. And so the markets could continue to move higher from here, even though we're all anticipating that big tear the Band-Aid moment off, market capitulation moment. The question is, are we going to get it? Are we going to get it in 2023? I'm going to give you guys my view in just a moment. But we need to take inventory of where we're at in the first quarter of 2023. Here it is, March 21st, and the S&P 500 is barely 16% off of its all-time highs. That, guys, is not a market in free fall. It's not a market in capitulation. It's not a market that you necessarily want to be buying right now either, because we haven't fallen. We haven't pulled back. Now, there are stocks and there are companies that are 70, 80%. They fell. They created a buying opportunity. And you know what? You're sitting there thinking, well, I'm going to not buy these even though they're 75% down, because the big crash, capitulation, recession that's coming in 2023, that means it'll get cheaper. It'll go lower. Absolutely not going to happen. There's already companies that have bottomed out. They bottomed out in June or October of 2022. There's some companies that have bottomed out in January of this year, and that's the lowest they're ever going to go. They're not going to go back down to those prices. But we need to get perspective of what the timeline is going to look like, because right now the markets, they are nowhere near giving us the big black day of trading, that big 30% drop that people have been talking about and anticipating. When will that happen? I'm going to give it to you. Before I do, if you guys need better trade tools, check out the top pinned comment. There is a link to the investment app Moomoo that's offering up to 17 free stock to open and fund an account. That is an exclusive and limited time offer. Go ahead and click on it to get all of the details. I use Moomoo every single day. All right. To really get to the bottom of this question about when the big drop is coming, let's look at what the market is expecting versus what the Fed is saying and ask ourselves, who's right?
I think they should pause, and I think they will, and I think that's how you reclaim your credibility.
They should pause right now. They really should not raise 25 basis points for a number of reasons. Reason number one, inflation is coming down. After the events of last week, it's definitely going to be coming down faster than the reported results. Look, the banking system is in peril right now. You run the risk of breaking something more than it's already broken.
You cannot simultaneously be rescuing the 15th largest bank and raising interest rates. The two things do not make sense.
And if they raise those 25 basis points, within 2 to 3 months, they'll be taking that 25 basis points back off.
That's part of what caused the crash of 87. They stopped, looked around, cut rates, and then they were back to hiking. It would be ahistorical to say that the Fed will throw its credibility out the window by reacting to what is clearly a financial crisis brewing.
Okay, Wall Street clearly believes that we're in crisis, that where cracks are in the foundation, the building is shaking, it's getting ready to come down, but the Fed is ignoring it, and he is simply bold-faced bluffing the markets with this talk that they're going to raise rates higher and they're going to hold them till the end of the year. I'm going to do another video about how the debt, America's debt, is stacking up with these high interest rates, how hard it is for the American government to maintain paying its debt under these high interest rates. There is a very strong argument to be made that they simply can't hold the rates up till the end of the year because the amount of money that they're going to have to put in to the interest on paying the debt is going to be close to $1 trillion, further causing the printing of money, further causing inflation that ultimately people would say that's when you're going to get the hyperinflation, when you basically can't print your way out of the problem. Of course, we know after that, there's always one more solution, which is another video that I'm planning down the road. But let's just talk about the fact that the market does not even believe right now. There's a lot of people that do not believe the Fed is going to have the ability to raise that next interest rate, that he got this one off barely, and that we're going to get more crisis, more of a credit crunch, more banking issues that are going to begin to implode, and that he is simply not going to be able to get off that last hike. And then giving him only 30 to 60 days after that, he's going to need to do an emergency 1% rate cut. That's what people are expecting. We know what the Fed's saying he's going to do. He thinks he's holding till the end of the year, and that's if nothing unexpected happened. Well, we've already seen these banks falling. We already see that the unexpected has begun. And so I think it's a little bit optimistic of the Fed to imagine that we're going to continue through the end of this year with no problems. There's going to be more problems. And I think the market is seeing that in advance because remember, the market's forward looking. It's always looking 6 months down the road. The market's already imagined these big, massive problems materializing and the Fed having to respond to them. And so they're buying stocks based on that situation that they believe is going to happen, not on what the Fed is saying. That's at the end of the day. That's why we hit 4,000 today. The market has gone up, even though there's so many problems. The market will continue to go up based on this idea that they have until things prove them different. So let me analyze, when will this big potential market crash that everybody's been talking about, when could it happen based on the market's idea or based on the Fed's idea? Well, typically or historically, every single time the Fed has begun to cut rates, it's taken 14 months for the stock market to find its bottom on average. That's historically. So if the Fed is right and he's able to raise rates one more time and then hold those rates all the way till the end of this year, believe it or not, that would mean that April or May of 2025 would be when the markets would hit bottom. That's not something anybody's talking about. And when you stop to think about it from that perspective, from that historical data perspective, you begin to realize why the markets do not believe the Fed and why they've been buying right now, even though we're still raising rates, because they're already anticipating that the markets can continue to go higher until we get to the place when the Fed actually pivots, which should begin to signal a downward trend from that point forward. When the Fed begins to pivot, because at that point, there's going to be a lot of bad stuff happening, forcing his hand, forcing him to cut rates, forcing him to pivot, which is going to bleed into the economy, which is going to bleed into earnings, which is going to mean that stocks are priced too high right now. And then at that point, they're going to begin to go on sale and they're going to begin to sell off. But until that happens, the markets are taking advantage of the situation and moving higher. So just to restate the situation to you, historically, whenever the Fed has been raising rates into a weakening economy, right now the economy is weakening because we've gone from a projection of 0.9% growth to the end of this year, 0.4% growth, and that's down from the average of a 3% growth. So we're absolutely in a weakening economy. Whenever the Fed has raised rates going into a weakening economy, it has led to a market crash. It's led to a recession. That's the exact situation we're in. And when he cut rates, it's been 14 months after that we've hit bottom. And so if we're going by the Fed, that means we're going to be in April or May of 2025 before we get to the bottom. But if we trust the smart money, if we trust the market, if we trust what it's saying it's all going to happen much, much sooner. What they're saying is that we should see rate cuts in months from now. 60 months, 90 months, there's not going to be another rate hike. We're going to see an emergency cut, a dramatic cut. Then the counter will begin, causing us to see a bottom potentially in 2024. That's the historical statistic that we're looking at. When those things come together, the market typically falls 28% from where it was at the moment that he began to cut rates. So guys, this goes back to what I said at the middle of this video, which is that not all the companies, not all the stocks, not all the crypto are just going to unanimously continue to go down together, all to their lowest prices at the lowest point, right? It's not going to happen that way. There's a ton of stocks and a ton of crypto, like I said, that will not go back to their June, October, January lows. I'd be surprised, I don't foresee right now, a Tesla stock back at $101. Not in 2023, not in 2024. If these guys continue to do well, continue to deliver, show that demand is strong for their cars, even in an environment of an economic slowdown, the market will forgive them a little bit. They're showing already that they're exceeding people's expectations. That stock may never get back down to $101. So you need to be going company by company. I talked about this in another video. I know you guys remember. I said I'm not a bull right now. I'm not a bear. I'm a buffalo. Buffaloes are not charging. They're not perma bulls pushing forward, believing the markets are going higher. They're not bears believing that we're in an apocalyptic crash. They're just out on the economic horizon, grazing, finding choice and ideal investments, taking in a little bit at a time, being cautious and careful, and building a long-term portfolio. You know, there's going to be a ton of opportunity for day trading. I'm doing some day trading. I got into some SQ, QQ the other day. I think there's a little opportunity there. I told you guys on Tuesday to watch the VIX on Wednesday. It pulled down to $20. I got in. It's jumped up to 22. I am expecting more volatility. I will be continuing to trade the VIX moving forward. Guys, that's all I've got for you today. I hope you found this helpful. Ask me any questions. Let me know whether you think the Fed is going to be able to hold strong or whether you think the markets are going to prove to be right in the comments section. Thank you again for hitting the like and hit that subscribe and that all YouTube notification bell to join me on this journey. Peace and blessings, my friends. We'll talk to you tomorrow.